Let's get in Vikas Khemani, founder of Carnelian Asset Management and Advisors, on our show to talk about how does he see the current landscape. Vikas, great having you. Thanks so much for joining in. The smile on your face tells me that your portfolios are doing well. Is it that the markets are conducive, or are you beating the market currently?
I think smile on your face should be irrespective of how the markets are, because markets will be good and bad all the time. And I think what we learn over the years is that you got to live with all kind of markets.
That's true.
But coming to your question, I think yes, of course, we've been doing well. From the latest low points, we have recovered. We have generated significant alpha. So I think yeah, we are happy. Our investors are happy.
Because is there reason to be constructive markets currently, or is there reason to be cautious? I mean, one geopolitical conflict hasn't ended and there is one more, but the markets are kind of showing resilience to that now. It's almost as if you're living with these and they may not impact sentiment too much. How do you foresee the next 6 to 12 months to be like for Indian markets?
So Neil, I think we will be in heightened geopolitical situation, not only now for next, in my opinion, next couple of years, or maybe next 5, 10 years. It's been going on for last couple of years since 2022, and markets get used to it. Historically, wars and geopolitical conflicts were far, far relevant for economies because of the oil price hike, and which is what partly played out in 2022. Fortunately, I think because of the oil cartel breaking, or I think, different source of supplies coming about, and countries managing to import oil from different sources, I think oil prices continues to remain in check despite the conflict in the Middle East. And I think that gives the big respite from a economic impact on the local economies, including India. So that's the reason I think by and large the dependence on the one source of supply of oil and oil prices are kind of checked. And if you keep that in mind, then I think broadly by and large and normal conflicts will keep happening. There will be news flows, but news flows don't have impact on the on the economic growth and on the corporate earnings, right? So hence markets are kind of overlooking that. And today, I say that India is far more resilient as an economy. What our governor, RBI governor has done in last 6 months is phenomenal. The 100 basis point rate cut and infusing liquidity in the system is far, far more powerful than anything happening in the world, because this is going to be growth boosting. And I do believe that in the current year you will see earning upgrades happening. There was a data I was seeing yesterday that in the March quarter, the positive surprises ratios went up from December quarter, and I think you will see the positive surprises ratio versus disappointment ratio will keep on inching up, in quarters to come. And as that happens, I think markets will keep doing well. I don't see any structural risk to the economy. I don't see any structural risk to the markets. Of course, sentiment driven, news flow driven correction can come anytime. Nobody can predict that. Nobody can plan for that. Other than that, I think business is as usual.
Vikas, is this a great opportune time? And we've seen this with crisis after crisis when it's a geopolitical crisis, even with the regional crisis, we saw trade tariffs, that there's a few days of uncertainty and then we come back to basics, which is an essentially strong economy, Q4 not as bad as expected, and from the second half of this year, things expected to improve. Is this an opportune time to shore up portfolios? And what would you say to those sitting on the sidelines or sitting on cash?
I feel bad for if you're sitting on cash, but I would say that you should have deployed last month, but it's never too late. Jab jago tab savera. So as long as your horizon is longer term, like I said, short term, I have no idea what can happen, but I don't see any major risk, and I see more positive momentum building towards markets doing well. I do believe that this year will hit new high, and corporate earnings will be in the range of 13 to 15%, which is I think very robust number, and hence that's the view one should deploy in. And history tells us that whenever interest rates do come down, markets do well, both from a growth perspective as well as a discounting rate perspective. We haven't seen anything happening in a meaningful because of the global uncertainty in the tariffs and the geopolitical. So to that extent, even at the current valuation, current price, current markets, you are getting a good deal Again, I repeat again and again, saying that view has to be, longer term. I don't know what can happen in short term, but I have no doubt that markets will do well. And that's certainly you should invest.
Okay, what are the spaces that you're finding interesting, Vikas? Would you say that BFSI, for example, a little ignored? Do you think that consumption theme now needs to be picked on, or are you as excited about defense as the street seems to be? Just trying to get a sense of where your attention is right now.
I think for us, they don't change very often. We have taken a call that, we broadly play in five opportunity spaces where we think there's a great opportunity over the next 5, 10 years. Number one is banking and financial services. Again, it's a wide thing, but within that, you pick your stock. Right now, we are very, very overweight in this particular basket. Second one is the entire manufacturing basket where we think that, again, the structural opportunity is there. Within manufacturing, you can have a very wide range, right from specialty chemicals to auto components to pharmaceutical to CDMO players to defense to, EMS, all kind of things, very wide play. But, so that's again a basket. We've been very positive. Of course, you keep making changes based on the how what kind of companies you find and what kind of ultimately it boils down to finding a right company. Third one is consumption. As our per capita income goes from $2,500 to $18,000, you will see many people consuming more new and better, and that would create significant opportunities in the marketplace. So that's a and fourth one is the infrastructure space where India is spending a lot of money roads, railways, airports, everything, right? And there will be lots of opportunities out there. And the last in the services space, which includes IT services as well as the non-IT services, such as travel, tourism, and all. And within those, you can have very interesting. So across these five spaces, you got to identify companies which can offer, superior risk-adjusted reward, risk reward. And we don't chase fads, we don't chase volume, undesired valuations. So I think you have to kind of stick to your knittings, and that's what we do. So across these five spaces, we made no changes in last month's crisis. Also, when the tariff was there, we had to make no change in our portfolio, and that just trying to say that India is a very structural story, and if you believe in that, you don't need to react every now and then and adjust your portfolio if your view is long term.
Because amongst other things that have worked beautifully, and IT over the years, etc. But I'm stuck on this whole CDMO piece because the stocks are continuing to perform, right? My question is are the future benefits, some bit of them or all of them, in the price already because of the sharp rallies that we've seen, or do you reckon that this could continue? And are you betting on the larger names or some of the smaller names? Because we've interviewed some of the smaller names because of late, and their guidance for growth is very, very large for the next 2, 3 years.
So, Neeraj, I think, in fact, if you remember in some of our previous conversations, I have said CDMO is a trend where probably IT was there 20 years ago, in mid 90s and late. So I think it's a very, very long-term trend. And, fact that, lot of opportunities will move away from China and come to India, it's a big opportunity. Now, it will play out unlike, this requires a lot of approval, this requires a lot of sort of manufacturing facilities build out, all those things. So this is not as simple as IT in terms of having a linear growth. It typically happens in step functions. So you will see 2 years of consolidation, then 2 years of growth. Because by the time you put up new capacity, it takes time. So I think this is how the nature of the business is. I remember we bought Laura slightly ahead around 300 rupees, last year, and for 6 months it didn't do nothing and it didn't do anything. And then I think suddenly you saw, numbers coming, and same thing happened with us in Newland, which from 1800 with 3 or 4 quarters number coming through went to 14, 15,000, right? And of course, profits also jumped to, suddenly a 40 P stock started looking at 20 P. So that's what happens when you have a bit of a non-linearity in your profits, and that this space offers. And hence one has to understand. Of course, one can't say, that every time it will happen, because again, there are a lot of uncertainty involved, and one can't say that with every company it will happen. And hence one has to be very careful and know the subject, because what happens is that when the fads build, now every CDMO, everybody will start positioning as a CDMO company, and then retail investors will get carried away and they will get valued, and then that's how money will be lost. So while I'm saying CDMO is a play, it does not mean that every company will succeed, just like every company did not become big in IT services.
Yeah, that's true. That's true. Okay. Well, out of time completely on this. Unfortunate. We could talk only 9-10 minutes, but it was still good enough. Vikas, thank you so much for taking the time out and being with us and giving us your thoughts.
Pleasure is always mine.